Well, hi everyone, and welcome to Buffett and Beyond. And today we're going over a stock in the automotive business, and that is Tesla. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And the question on Tesla today is, do we buy, sell, or hold? Because it has been having a rough time lately. And we have new numbers on the projections, and folks, they're out to 2025. So this is all new. You haven't heard it anyplace else yet. Okay, let's look at the positives here. All cars are or will be mandated by the government in the future to be electric vehicles, EVs. Now, Tesla is a brand name relative to its product, just like Coke or Heinz. When you think of a soft, cold drink, you think of Pepsi or Coke. When you think of ketchup, you think of Heinz. When you think of tissue, you think of Kleenex. And folks, Tesla doesn't use dealerships, just saving a big cost of a new car. Now, is Tesla a battery company? Is it going to get money? And the answer is yes. Is it going to get money from those charging stations it's putting up? Yes. And Kathy Woods from the ARC Technology ETF that she runs, she's talking about in 2 years, we will see self-driving cars coming to pick us up when we push a button on our phone. And folks, that's what I'm waiting for too. Now, let's look at Tesla, and we're going to look at the clean surplus return on equity. Tesla is green. The blue is the average stock in the S&P 500. When we look at the clean surplus return on equity, Tesla has the average stock beat. When we look at net income, Tesla really has the average stock beat. And when we look at revenue, Tesla is all over any average stock out there by looking at about 4-to-1 in revenue. But the problem is that there is something going on under the hood of this car here that we're going to take a closer look at, because this chart makes it look wonderful, but is it wonderful, especially after the recent decline that it's had? So when we look at net income, so net income is the clean surplus earnings. So you take traditional accounting earnings, you take away non-recurring items, you take away future liabilities, and this is what you come up with. So this is an older, about over a year ago chart. And look at this number for 2024, $4.65. So remember that just for a few seconds, because we're going to the next slide. Again, 2024 was projected to be $4.65. Let's come back up to here to today's numbers and further projections. We're looking at 2024. It is not $4.65. It's $3.08. So that is not very, very good, folks, because remember, Tesla lowered their prices, and they lowered their prices again. Why? Because they're keeping market share. That's what they're doing, because who are their rivals? You got Ford, you got General Motors. Yeah, you have a lot of car companies that are in the EV business. But coming back for 2025, they're looking at $4.19. So what does that do to the clean surplus return on equity? And we use the clean surplus return on equity to compare one stock to another. Now, the average stock out there has about a 13.5% clean surplus ROE. Now, look at Tesla for 2022 and 2023 in the 20s. And to get into our growth portfolio, we want to see a stock above 20% clean surplus ROE. That's why we have Tesla in our portfolio. But what happens for 2024? The outlook is that this is going to be cut almost in half. However, when we look at 2025, we see it coming back once again, back up to 16.2%. So here's our problem. We have a stock that is in our growth portfolio because it had an ROE of over 20%. Think of your bank account. Do you want to be in the average stock bank account giving you 13.5%, or do you want to be in bank account Tesla that's giving you over a 20% ROE? No question about it. But now, all of a sudden, it fell down for 2024, expected to fall down to be an average stock. However, with 2025 expected to go up an ROE. And this is where we were with Visa about 10 years ago. We had an ROE that was rising. It was below 20%, but it was rising, and the market likes a rising stock. Right now, what's it looking at? It's looking at a falling clean surplus return on equity, so it's selling the stock off. So that's what we have to look at. Now, let's come over here. Net income growth, and we're only taking 4 years because back in here, 2020 to 2021, we had a huge jump from 21 cents up to $1.63. That comes out to 676%. Well, okay, that's an outlier there. So we just took the last 4 years, and still we have a 37% net income growth on a 4-year average. It would be much higher if we included this down here. But of course, this bothers us, this reduction, because Tesla lowered their prices, therefore it lowered its profits. But they expect it to be going up for next year. Now, that nice growth at 36% is very, very nice, folks. Now, when we come to revenue growth, we can really see that for 2024, this year, it's only going to be 4.1%, but then doubling, more than doubling for next year. But the 5-year average, 27.5%. So we're in a quandary here. There's no doubt about it. There's a lot of questions. Will this company be able to come back? Well, now let's look at debt. And this is years to pay debt. If a company took all of its money and used it just to pay off its debt, how long would it take? Well, this company could pay off its debt in 3 or 4 months, folks. So that means practically, as far as we're concerned, it has almost no debt at all. And dividend is 0. That means the retention rate, it's taken all the money that it's making and putting it back into itself in order to grow, because it's coming out with new models. And that's where they spent a lot of money this year in 2024 into their new models. So we're kind of going to stick with Tesla Motors in our portfolio here, folks. Now, let's look at 1 year, and yeah, here it is. The black line is the S&P 500, which has been going up nicely over the past year and 4 months now, and Tesla has been going down over the past year. So that's not, or the past month, I should say. So that's not looking very good in here, especially when you bought it back in here when everything was looking very, very good on this stock. Over 5 years, yeah, here's where we bought it, folks, right about in here. Because this is 2022, this is 2023, this is 2024, this little bit in here. So we bought it right at the end of 2021 going into 2022. So we bought it right around in here, pretty much near the top up here. And so we sustained the loss in here. But even though for 2022, we've been down, or Tesla has been down 65%, our portfolio was not down that much. It was down less than half that, and we have come back in this year. Tesla has come back, and our portfolio for 2023 is up 52%. So even though Tesla has had a hard time, it's added to it, not as much as the overall portfolio, but that's why you have 30 stocks in a 30-stock portfolio, folks, in case Tesla falls like this. So let's look at a closer look of Tesla and how it's been doing, and here's the big decline. Oh my God, that just looks terrible, doesn't it? So, but let's look a little closer, and here we have this stock, first of all, gapping down, and remember that gap. We're going to talk about it in a second. So we have a lower low here in the stock. But up here in this short-term indicator, remember I said short-term indicator, we have a higher low. Well, when you have a higher low in the indicator but a lower low in the stock, that is a bullish divergence. So we have a bullish divergence here. Now, we take a look at where this formation is, and we look back over here and we draw this line lower. So we have the stock going lower than last time it fell. And let us look at this indicator down here, which is an intermediate term indicator. And we can see that last time it made a low, this is where the indicator was. And did the indicator fall any further? No, it didn't. But did the stock fall further? Yes. So we have a lower low in the stock, but we do not have a lower low in this indicator here. So with this indicator turning up, this intermediate term indicator turning up, it looks like we are very, very close to a buy signal. In fact, we actually got the buy signal up here in the short-term indicator, and it looks like if we can get another day or two, this black line crossing the red line, yeah, that's what we want to see. So let us go back to this term, the gap. It gapped down because it closed one day at this price and the next day it was much lower. That is not a good sign, folks. In fact, that's about a 22-point drop overnight in this particular stock, and nobody likes that. That's why everybody got scared. But maybe it needed that to start basing out once again. And we look at this as at least this stock is going to try and fill this gap. Gaps are always filled. It doesn't mean the next day or the day after or a month after. It could be 6 months from now, but this gap will be filled sooner or later. And if the market stays good, we just might see this stock come up and try to fill this gap. So when we're looking at buy, sell, or hold, well, folks, it might be a good buying situation. Definitely a holding situation because we would not sell it in here. It looks like this stock is starting to base. So, folks, we want to get back to our good old Tesla as the car company, a battery company. All cars are going to be mandated to be electric vehicle cars going into the future, and they're passing mandates as we go along. And Kathy Woods, who runs the technology ETF, or the ARC technology ETF, she is sticking with Tesla. It's her biggest holding because she says in 2 years when they come out with that driverless Uber, I shouldn't call it an Uber because it's not an Uber, but the driverless taxi type of car, which I personally am waiting for, this stock is going to move, and she has full faith in that. Plus, we have the charging stations. Tesla owns those charging stations, or most of them. So it's going to get money from different sources going into the future. We are going to stay with Tesla in our growth portfolio, and our portfolio doubled the S&P last year, and it's doubling the S&P this year, even though Tesla has given us fits this year because it's one of the few stocks in our portfolio that's down. But we're going to hold on to it just because we like what we see in here. So, folks, we had a rough time with Tesla, but we're having a good time with the overall market. So go out, clear your heads, go to the beach if you're in the south, go walk through the snow if you're living up in the north, be with your family, be with your loved ones over the weekend. And folks, you have a good time. Stay safe over the weekend because guess what? The market will be open back here again on Monday, and we'll see you next week, folks.